It is now a great honor and pleasure to introduce Eric Budish. Eric is another Harvard alumnus, having got his PhD here, and is a professor of economics at the University of Chicago in the Booth School of Business. Eric's an expert in market design, and he's also been a great friend and ally of computer scientists who are working in that space as well. And today, we were really excited to have him here to talk about the way you can use market design to fix some of the things that might be undesirable about having these algorithmic players inside markets. So really great to have Eric here today. Please join me in welcoming him.
Thanks to you all for being here, and thanks, David, for the invitation and for your mentorship over the years. So David described himself as a computer scientist who's also secretly an economist, and I'm, I guess, an economist who's not quite as good at computer science as David is at economics, but I have my aspirations, and David was on my dissertation committee along with, surrounded by the economists, and I'm really grateful to you for your mentorship over the years, and I think there's a lot of fascinating work to do at the intersection of economics and computer science, and I'll talk about some of that work today. My topic for today is the design of financial exchanges. I've followed the stock market since I was a little kid. I remember reading the newspaper stock pages with my father the morning after Black Monday as a 9-year-old and debating whether the market was going to go up or down the next day. And I predicted, I was kind of an optimistic kid. I predicted it would go up. I told my father to buy IBM stock. I looked the other day, and it actually went up like 10 points the next day. So it was my first good stock call. But the first serious intellectual idea I came across, I was exposed to about finance, and I'm sure this is true for many of you, was the efficient markets hypothesis. The efficient markets hypothesis says that a market incorporates all available information about asset prices. It's described by Gene Fama, my colleague, as, quote, obviously an extreme null hypothesis. And so he usefully distinguished between three operationalizable versions of the hypothesis: weak, semi-strong, and strong. The weak form says you can't beat the market, make risk-adjusted excess returns, using just past prices as your information. The semi-strong form says you can't beat the market using both past prices and other forms of public information, like company news and earnings releases. And the strong form says you can't beat the market even using private information, insider information, or other forms of asymmetric information. And Fama concluded that there was evidence against this strong form, but that the weak and semi-strong forms held up pretty well. And the plain English translation is that to beat the market, you have to know something that the rest of the market doesn't know. So my IBM call as a 9-year-old was not skill. Our modern understanding of market efficiency, as summarized by the 2013 Nobel Committee, is that stock prices are, quote, next to impossible to predict in the short run, but that there's a meaningful amount of predictability in the longer run. For instance, using the market's price-earnings ratio, or by favoring value stocks over growth stocks. And the main debate within academic finance is over how to interpret this long-run predictability. To what extent does it reflect variation in risk across time and across asset classes that we may not fully understand, but that's perfectly consistent with market efficiency? And to what extent does it reflect behavioral biases in financial markets that are inconsistent with efficiency? But that the market's hard to beat in the short run is, in academic circles at least, relatively uncontroversial. The Nobel Committee wrote that, quote, such a situation would reflect a rather basic malfunctioning of the market mechanism. In 2010, a company called Spread Networks spent $300 million to dig a high-speed fiber optic cable between financial markets in New York and financial markets in Chicago. And the important feature of this cable is that it was dug in a relatively straight line. whereas previous connections between these markets zigzagged along railroad tracks and around mountains and so forth. And the straightness of this cable shaved round-trip data transmission time between New York and Chicago by 3 milliseconds, so by 3,000ths of a second, or roughly 1/100th of the time it takes to blink your eye. Industry observers described 3 milliseconds as, quote, an eternity. They joked that the next innovation would be to dig through the Earth, so go through the Earth rather than around the Earth, quote, avoiding the planet's pesky curvature. And this joke actually quickly materialized. So nobody actually literally dug a tunnel, but microwaves are a different way to get information in a, quote, straighter line than fiber optic cable because light travels with less refraction through air than through glass. And lo and behold, by the next year, by 2011, a microwave connection was live between New York and Chicago. So when I first read about this cable, and I remember it kind of viscerally, I was just starting my second year as an assistant professor at the University of Chicago, I really didn't understand it. It was pretty obvious that it was some kind of arms race for speed, but what wasn't at all obvious to me, and if this makes me sound unsophisticated, at least in retrospect, so be it, was what the speed was for, because 3 milliseconds seemed obviously too short to be about fundamentals. Again, this is 100th of the time it takes to blink your eye. To put it in perspective, companies release earnings once per quarter, which is once per about 8 billion milliseconds. And this is after the market's closed, so you can't trade on that anyway. And my academic efficient market instinct was to be deeply skeptical of trading strategies that are short run and purely technical. When academics hear phrases by commentators on CNBC, for instance, like 200-day moving averages or head and shoulders patterns or support points or so forth, we kind of roll our eyes. As Burt Malkiel wrote in the famous book, A Random Walk Down Wall Street, he wrote, technical strategies are usually amusing, often comforting, but of no real value. So my collaborators, Peter Crampton, John Chim, and I tried to make sense of the high-frequency trading arms race, approaching the topic from the perspective of market design. What I mean by that is that market design research assumes participants in a market act rationally in their best interest given market rules, but takes seriously the possibility that the rules themselves are flawed, and does so at a level of institutional detail, of fine engineering detail that is unusual in some other parts of economics that works with more stylized models. Al Roth calls this economic engineering. And I'll note as a University of Chicago guy that even Milton Friedman himself emphasized the importance of getting the right, quote, rules of the game in place before letting market forces do the rest of the work. And indeed, our research identified a simple structural flaw in the design of modern financial exchanges, essentially a math glitch that got introduced in the transition from human-based trading to computer-based trading, which on the whole, by the way, has broadly been good for financial markets, but this glitch has been bad for financial markets. The flaw is that exchange computers treat time as a continuous variable and process requests to trade serially, that is, one at a time in order of receipt. Essentially, when markets transition from being run by humans to being run by computers, which, again, on the whole has been a good thing, we made a mistake and forgot to put time into units. This flaw causes a violation of the efficient markets hypothesis built directly into the market design. In an efficient market, to make money, you either have to, 1, take risk, or 2, have private information. But what I'll show is that built into the current market design are profitable arbitrage opportunities that are, 1, riskless, and 2, use only symmetric public information revealed to the whole market at exactly the same time with economically obvious implications. So I want to underscore this, that the details of the market design, the plumbing of modern financial exchanges, causes a violation of the efficient market hypothesis built right in. And these arbitrage opportunities aren't supposed to exist in a well-designed market, and they harm the market in 2 ways. So first, they make markets less liquid. As you'll see, they're like a tax on liquidity provision. And second, they induce a never-ending arms race for speed. Our paper then proposes an alternative market design that directly addresses the problem. And the basic idea is simple, which is to put time into discrete units. If multiple requests to trade arrive at, quote, the same time, award the trade to whoever offers the best price. So run a mini auction. And this market design, which we call frequent batch auctions, and that may also not be the best name, but that's the name we chose, it fixes the failure of the efficient markets hypothesis. And in doing so, it improves liquidity and stops the arms race. So my plan for this talk, I'm going to spend most of my time on the first part of this talk, is I'm going to tell you about this research with Peter Crampton and John Shim in some detail. I'll give you some new empirical facts about how the current market design behaves at high-frequency time horizons. I'll go over a simple theory model that shows what's wrong with the current market design. And then last, I'll show you how moving from a continuous time serial process market design to a discrete time batch process market design directly fixes the problem. I'll then spend a few minutes on the second part of this talk, which was organized around the main question I've gotten about this research across academia and from industry and from various kinds of regulators, which is, will the market fix the market? That is, will market forces on their own fix the problems we've identified, or is some kind of a regulatory intervention necessary? All right, so just to make sure we're all on the same page, let me spend one slide describing the current market design that's predominant in organized financial exchanges around the world. And this includes stocks, but also various currency markets and some kinds of fixed income assets, futures markets. It's really quite predominant globally. It's called the continuous limit order book. The basic building block is a limit order. A limit order specifies a price, quantity, and a direction. So buy 100 shares of XYZ at $100. Traders or other market participants submit limit orders to the market at any time during the trading day. And they can also cancel or modify outstanding limit orders. And these orders and cancellations, sometimes called messages, so messages sent to the exchange, get processed by the exchange one at a time in order of receipt. That is, as a serial process. The set of outstanding orders at any one moment in time is known as the limit order book. An example of a limit order book is depicted on the top right of the slide. And trade occurs whenever a new limit order is submitted that's either an offer to buy at a price greater than or equal to some outstanding offer to sell, or vice versa. So in the depiction at the right, if I sent an order to buy at 62.36 or higher, I will buy shares of Microsoft stock. And the data that we're going to use first for the empirical part of our study is roughly the play-by-play of the limit order book. So I want to begin with some empirical facts that show that continuous time markets don't behave as we might expect them to, literally in continuous time. So this is the plot of the price paths over the course of a trading day for the two most liquid instruments that track the S&P 500 index, the E-mini future, which trades in Chicago on the Mercantile Exchange, and the SPY Exchange Traded Fund, which trades in New York on the various equities exchanges. It's millisecond-level direct feed data, the same data that high-frequency trading firms subscribe to and parse in real time. We bought and analyzed retrospectively. So over the course of a trading day, these two instruments are very highly correlated, as we'd expect, since they track the same index, the S&P 500 index. Here's an hour of data, a minute of data, and then this is what the market starts to look like when you zoom into high frequency. This is a quarter of a second of data, 250 milliseconds. And when you zoom into high frequency, the correlation between related assets falls apart. The correlation's basically 1 at a minute or an hour or a day, but the correlation's basically 0 at a millisecond. It's less than 0.01. And incidentally, it doesn't matter how you account for relativity in computing the calculation of this correlation between assets, and the fact that you might even occur to you to account for relativity when calculating financial relationships is sort of telling in and of itself. The reason this phenomenon matters is that it creates obvious mechanical arbitrage opportunities. So for example, when the price in Chicago jumps and the price in New York hasn't responded yet, the arbitrage is to buy cheap in New York and sell expensive in Chicago, or vice versa. Now, the usual efficient market story with obvious arbitrage opportunities is that once discovered, the arbitrage gets competed away. That's what's supposed to happen. And I want to show you that that's not what happens here under our current market design. So we find that the duration of arbitrage opportunities has come way down over time, from in excess of 100 milliseconds at the start of our data in 2005 to around 7 milliseconds by the end of our data in 2011. The profits per arbitrage opportunity, however, have stayed relatively flat over time. The arbs are not being competed away. And the frequency of arbitrage opportunities does fluctuate over time, but the frequency is mostly driven by market volatility. So 2008 was a period where there were a lot of arbitrage opportunities, for example, as opposed to market forces competing away the arbitrage. And this is just a complementary way of illustrating the same phenomena. On the right-hand side of the graph, we see that in each year of our data, the market's getting faster. It's incorporating information from Chicago prices into New York prices, and vice versa, faster and faster each year. This reflects as the 100 millisecond correlation between assets getting higher and higher in each year. But in all years at high enough frequency, the correlation's essentially zero. So to summarize, competition does raise the bar for how fast you have to be to capture obvious mechanical arbitrage opportunities, but competition does not seem to have eliminated the arbs or even reduced their total size. And this suggests that we should think of latency arbitrage and the resulting arms race for speed as something like a constant of the current market design. And I'm going to illustrate this point in the theory. In our data, we compute the size of this one arbitrage opportunity, the ES SPY arbitrage, to be about $75 million per year. And we think this is an underestimate for reasons we go into at length in the paper. But more important to emphasize is that this is just the tip of the iceberg in the race for speed. Now, this is where we were able to get data. But conceptually, all continuous electronic markets around the world are similar. There are lots of highly correlated instruments, and nothing in the market architecture to enable prices to move at exactly the same time. So as one example, here are pairs of highly correlated treasury bonds. Here's some other equity indices. Here are currency pairs, gold and silver. Here's oil and gas. Here's coffee for those of you sleeping. Here's just a long list of obviously correlated pairs. In U.S. equities markets, there are also arbitrage trades that are even simpler than the one I've been studying, because the same stock trades on as many as 13 different exchanges and about 50 dark pools. These within symbol high-frequency trading opportunities were at the heart of the Michael Lewis book, Flash Boys. There's a race to respond to public news, such as company news, government data, or other macro indicators, such as consumer confidence numbers. And this race to respond to public news was at the heart of the New York AG's initial interest in high-frequency trading, what he termed insider trading 2.0. There's a race to the top of the book, artifact of minimum price ticks. I still don't think it's possible to put a precise estimate on the total size of the prize in the speed game, but a common sense extrapolation from our numbers and from other academic numbers that are out there suggests that the sums are substantial, easily single-digit billions per year in U.S. equities alone. And if you extrapolate from U.S. equities to the rest of the world, it's relatively easy to get to double-digit billions per year. It's hard to get to the $20 billion per year number in U.S. equities that Michael Lewis cites in the book Flash Boys, at least based on the data that's academically available. If you take a net present value of these annual amounts, and since latency arbitrage is like a tax on trading, the size of the prize grows with the market. So you should discount at a relatively low rate. If you remember your Gordon growth model, it's easy to get to in excess of $100 billion of net present value. I don't think this is the #1 policy problem in finance, but it's big and worth trying to solve. Okay, I now want to move to the theory model. And the model's really quite simple. I think it's very teachable, and I want to go over the setup and main ideas in a little bit of detail. So the model's a descendant of the famous Gloston-Milgram model. If anything, it's a bit simpler. There's a security that I want to call X. It trades on a continuous limit order book. There's a public signal that we're going to call y of the value of security x. And I want to make a purposefully strong assumption, which is that x is worth y. So the fundamental value of x is perfectly correlated to this public signal y and can always be cautiously liquidated at this value. And the goal of this assumption is to create a best-case scenario for price discovery and liquidity provision on the continuous limit order book, assuming away issues like asymmetric information and inventory costs. I really want to isolate the core flaw. The public signal y evolves as what's called a compound Poisson jump process. This is just a fancy way of saying that with some probability, the public signal jumps either up or down by symmetric amounts. And what really matters economically is the absolute value of jumps, and we're going to denote by cap j the distribution of the absolute value of jump sizes. There's two kinds of players in the model, investors and trading firms. Investors I think of as representing end users of financial markets, and we're going to model them very simply. They arrive to market needing to either buy or sell 1 unit of x. They've got an arrival rate lambda invest. When they show up, they trade immediately, buying at the ask or selling at the bid. Second are trading firms. Trading firms don't have an intrinsic demand to buy or sell x. Their goal is just to buy low and sell high. Initially, I'm going to assume that there's at least 2 trading firms just exogenously present in the market, and later I'll endogenize entry. So initially, I want to assume away all latency. So when y changes, everybody sees this with 0 time delay for free. There's no latency in sending messages to the exchange or receiving information from the exchange. Again, I want to create a best-case scenario for price discovery and liquidity provision on a continuous market. So given the setup of the model, there's no asymmetric information, no inventory costs, no latency, and so forth, you might conjecture that competition among trading firms is going to lead to effectively infinite liquidity for investors. That is, you might think trading firms should offer to buy or sell x at price y in unlimited quantity at 0 bid-ask spread. We've turned off all of the usual sources of costly liquidity provision. But that's not what happens in the continuous limit order book because of a phenomenon that we call sniping. So suppose that y jumps from y1 to y2. So think of this as the moment at which the correlation between assets momentarily breaks down, like we saw in the data. If I'm a trading firm providing liquidity, I'm going to send a message to the exchange to cancel my old quotes based on y1 and replace with new quotes based on the information y2. Okay? However, at the exact same time, other trading firms are going to send a message to the exchange attempting to snipe my stale quotes. So buy my old quotes associated with y1 before I can cancel those quotes. And since the continuous market processes messages in serial, so one at a time, it's possible that a message to snipe is going to get processed before a message to cancel. So if I'm making a market here and there's information, I send a message to cancel. At the same time, all of you send a message to try to snipe my stale quote. The odds that I'm the first to get processed are low. Okay? So here I'm just going to give, because this is a big room, I just want to give a diagrammatic illustration of the sniping phenomenon. I usually do it with my hands, but I don't know if the people in the back can see. So here's the market. There's a public information y1. There's a bid and ask. Suppose that information changes. If I'm a trading firm providing liquidity in the market, I'm going to send a message to cancel my stale quotes, my stale bid and ask, and replace with new quotes, a new bid and ask. At the same time, other trading firms are going to try to trade at my old ask price before I can get the heck out of the way. And since the market processes these requests to trade serially, one at a time, the likelihood that I'm first is small. Okay? So in a continuous limit order book, symmetrically observed public information creates arbitrage rents. And again, this just isn't supposed to happen in an efficient market. We're all okay with the idea that you can make money if you know something the rest of the market doesn't know. If you bring asymmetric information into the market, there ought to be rents for that. But symmetric information is supposed to get into prices for free. And in equilibrium, these arbitrage rents are ultimately paid by investors. So there are a lot of details of the equilibrium analysis that I'm going to skip in the interest of time, but the basics are pretty simple. In equilibrium, trading firms are indifferent between liquidity provision and stale quote sniping. Liquidity provision earns revenues as investors show up and pay the bid-ask spread, and has costs when jumps occur and the liquidity provider gets sniped. Sniping has benefits when jumps occur, and these expressions, notice that the cost to every one liquidity provider is related to the benefits of the n-1 snipers trying to snipe him. And making trading firms indifferent between these two activities yields an equation that characterizes the equilibrium cost of liquidity for investors. What it says is that the profits trading firms earn from sniping come out of the pockets of investors via the cost of liquidity. So we can now endogenize entry by having a simple speed technology. So trading firms either see jumps in Y with a small time delay, denoted delta slow for free, or they can pay a cost, C speed, to see the information faster at speed delta fast. And think of delta slow as like the old cable and delta fast as like a microwave connection, or delta fast as cutting edge HFT and delta slow as last year HFT. Equilibrium is very similar to above. It's now characterized by two equations. One that's an indifference condition between liquidity provision and stale quote sniping, and the other which is a free entry condition that disciplines the amount of entry. And the new equation that comes out of the model says in words that all of the revenues trading firms earn from sniping, they dissipate by investing in speed. So that the prize in the arms race, expenditure on speed, and the cost to investors are all the same in equilibrium. So I'm a Chicago guy. I ask myself a lot and get asked by my colleagues a lot, what exactly is the market failure here? Isn't the arms race for speed healthy competition? And the model tells a tale of two market failures. The first market failure is sniping. Again, arbitrage rents from public information in violation of efficient markets theory. And the second market failure is that these sniping rents then induce an arms race for speed, which mathematically you can think of as like a prisoner's dilemma. I want to make two very quick remarks about the model. The first is that the model does not say that high-frequency trading per se is bad for financial markets. Rather, it says that high-frequency traders do two things endogenously. They provide liquidity and they snipe stale quotes. Providing liquidity is useful for investors. Sniping stale quotes is harmful to investors. And don't be misled by the fact that the sniping looks like zero-sum HFT on HFT combat, because this misses the economics. The economics is that sniping is like a tax on liquidity provision. The second remark is, if you'll notice, the size of the sniping problem in the model had nothing to do with speed technology per se. It didn't matter whether the faster guys were faster by seconds, milliseconds, microseconds, nanoseconds, or so forth. It also doesn't matter whether the speed technology is cheap or expensive. If it's cheap, there'll be lots of entry. If it's expensive, there'll be less entry. This tells us that the arms race is an equilibrium feature of the market design. It's going to keep going as long as we have continuous trading. And to illustrate, here are some highlights from the arms race since we first started this research in 2010. So here's the first microwave connection between Chicago and New York. It wasn't a straight line, but light travels a lot faster through air than through glass, so it was straight enough. This microwave connection actually started in downtown Chicago at the top of the Aon Center. This is what the microwave network looks like now. In the US, you'll notice that Washington, D.C. is part of a triangle of microwave connections from Chicago to New York to D.C. This is because government numbers, which are perhaps the purest form of symmetric public information there is, are disseminated from DC, and these government numbers generate a race to act. The location of the data farm these numbers are disseminated from is literally on K Street. Here's a microwave path currently in construction with data as of December 2016. It appears to be aimed at sending information from Chicago to Seattle by microwave and then the rest of the way to Asia by underwater cable. And here's a poster I saw recently at an industry conference for a hardware device for high-frequency traders with the tagline, nanoseconds matter. So a nanosecond is a billionth of a second. Every time you blink your eyes, 400 million nanoseconds have passed. Okay. So I now want to spend the last bit of my talk explaining why moving from the current continuous market design to our proposed discrete time market design directly solves the problem. And I'll make a few reflections at the end. So at a high level, our proposed market design, frequent batch auctions, modifies the current market design in really just two ways. So first, we put time into units. Discrete time is treated as a discrete variable, not continuous. And second, we process orders in batch using an auction rather than serially. So let me just define frequent batch auctions in a bit more detail. So during the batch interval denoted by of length tau, and I think practically you want to think of a batch interval of about a millisecond. I'll talk a little bit, we talk at length in the paper about how to think about the batch interval, but for today, think about 1 millisecond as the interval, so still quite fast. During the batch interval, traders submit bids and asks. They're exactly like standard limit orders. They can be freely modified, canceled, and so forth. And if an order isn't executed in one interval, it remains outstanding for the next, and the next, and the next, and so forth until it's either executed or canceled. At the end of each batch interval, the exchange batches together all outstanding orders, both new orders that arrived this interval and outstanding orders for previous intervals, and computes market-level supply and demand curves. If supply and demand don't cross, no trade occurs and all orders just carry forward to the next auction. If supply and demand do cross, transactions occur at the market clearing price. So it's a uniform price auction. Priority is still price than time, but with time discrete. And this means that if my order has been resting in the book for several milliseconds and yours is new this millisecond, I have priority over you. But if we both entered in the same millisecond, we have the same priority. And the information policy is that the same information is disseminated as in the continuous market, trades, outstanding orders, cancels, and so forth, but with the information disseminated in discrete time after each interval. And it's an important detail to underscore. It's economically important that information is disseminated in discrete time and not continuously throughout the interval. To explain how and why frequent batch auctions work, I want to go over 3 cases. So the first case is that nothing really happens. And this is a very common case because most instruments in most seconds, there's zero trade, let alone in most milliseconds. For a stock like Google, for example, there's activity in only about 0.5% of all milliseconds and trade in only about 0.1% of all milliseconds. And in this case, all outstanding orders simply carry forward to the next time interval, and the state of the book's displayed publicly, flashing on your screen or to your algorithm in discrete time. This is just like displayed liquidity in a limit order book. The bottom of the supply curve's the ask, the top of the demand curve's the bid. A second case is a small amount of trade happens. For instance, an investor shows up and wants to buy a small amount at market. And this case, too, is just like current practice. The investor can buy at the ask or sell at the bid, just like in the limit order book market. And the third case is that there's a burst of activity during the interval, for example, in response to public news. And this case is where discrete time and continuous time are importantly different. There's 2 reasons. The first, and I think more obvious reason, is that discrete time reduces the economic relevance of tiny speed advantages. As long as the batch interval is long relative to the difference between fast and slow traders, and don't think of fast and slow as high-frequency traders versus grandma, but think of it more like cutting-edge HFT versus other sophisticated market participants. Then most information arrives at a time during the batch interval when all traders see it equally. It's only a small sliver of the interval of proportion delta over tau, where if public information arrives during that sliver, the speed advantage is relevant. The second and more subtle reason is that the auction changes the nature of competition. Instead of competing on speed, trading firms compete on price. The easiest way to see this is to suppose that public information actually does arrive during the critical window, and that there are some slow traders with stale quotes in the book. In the continuous market, this is going to lead to a race by the fast traders to snipe the stale quotes, whereas in the discrete auction market, the fast traders compete on price. So if the information is truly public and obvious, the auction is going to compete away the arbitrage profits. In the interest of time, I'm going to skip all the details of the equilibrium analysis and just give you the main takeaways. If we treat the number of high-frequency trading firms as exogenous, and that's probably the right way of thinking about an initial entry of a frequent batch auction exchange or some kind of pilot test, then frequent batch auctions eliminate sniping for any batch interval tau. And this is a mathematical discontinuity as we move from continuous serial to discrete batch. Practically, I think of any batch interval as meaning an interval that's long enough relative to current computational and communications technology to enable genuine batch processing if multiple trading firms act on the same information at the same time. This is probably a millisecond or less. If we treat the number of high-frequency trading firms as endogenous, and this is the relevant case for thinking about a market-wide reform aimed at stopping the speed race, then the equilibrium analysis says that the batch interval has to be long relative to the speed advantages in play. And this might be a slightly longer interval, like 10 milliseconds or 100 milliseconds. In addition to stopping sniping, enhancing liquidity, and stopping the arms race, discrete time also has significant computational simplicity advantages over continuous time. The basic conceptual point is that computers and communications technology they're fast, but they are not infinitely fast. And a continuous time market implicitly assumes that they are. So let me give you just one example of the complexity this causes. Think about the market's paper trail. So think about some of the data that would be in the Goldman Sachs system we heard about in the first lecture. In a continuous time market, this paper trail has to be adjusted for geographical latency, exchange latency, clock synchronization failures. You have to know about relativity to know how to read the play-by-play of the market. Whereas in discrete time, all of this complexity goes away. Another example is that in continuous time, there's an intrinsic trade-off between code robustness and speed, because every additional if-then line of code takes time. There have been numerous other responses to the HFT arms race discussed in recent years. I discussed in some detail in the paper. The only thing I'll mention here is that bands seem to misunderstand cause and effect. And my thoughts on IEX's market design are fairly mixed and nuanced. And if you're interested, I'd encourage you to look at my SEC comment letter on their exchange application. So let me summarize Budish, Crampton, and Shim, and then briefly give you some of the post-game on that paper, and then wrap in the interest of time. So we look at the HFT arms race from the perspective of market design. The root problem isn't evil high-frequency traders. It's a market design glitch, continuous time serial process trading. And this glitch causes a built-in failure of the efficient markets hypothesis. It's simple to fix by moving to a discrete time batch process market design. This market design eliminates sniping, enhances liquidity, stops the arms race, and simplifies the market computationally. Okay, so the paper was released publicly in July 2013 and pretty quickly took on a life of its own, which I guess isn't surprising in retrospect given the subject matter, but it felt surprising at the time, and as an academic, it's always a bit of a pleasant surprise if your work does anything other than go into the void. Attention came not just from within academia, but from many different kinds of stakeholders, including exchanges, high-frequency trading firms, the large investment banks and broker-dealers, institutional investors, trade groups, many different regulatory bodies around the world. And my approach to the attention that the paper got, and I have no idea if this was the best approach personally or professionally, was most centrally just to invest a lot of time talking not just at academic seminars and academic conferences, but in lots of private meetings with stakeholders, lots of industry panel discussions and so forth, where sometimes it did feel like I was in the lion's den. I learned an enormous amount from these interactions about institutional details, about how to communicate the work, and I think a lot of the improvements that have come to the work over time were shaped by these discussions. The work, of course, had a range of reactions, some of which was quite positive. So the highest profile public support came from the New York Attorney General, Eric Schneiderman, who, among other things, noted that as a University of Chicago economist, I'm, quote, not an enemy of free markets. I, of course, agree with this. Bloomberg and actually Goldman Sachs, if you read the last paragraph, were full disclosure. I worked for a few years before graduate school, but as an extremely low-level investment banker. Support came from within academia, including, to my delight, across the ideological spectrum of my University of Chicago colleagues. And I'll close with perhaps my favorite compliment for the work, which I think is telling. So let me close here rather than let me make a few extemporaneous remarks about the will the market fix the market topic, but I'll use this slide to close. So I've identified a market failure that gets at the core of what we mean by an efficient market. The private market forces to correct this market failure aren't as aligned as you might naively hope. So, and we study this in a follow-on paper, and the basic reason for this is that exchanges have a vested interest in the status quo because the one piece of the exchange business model that generates substantial market power is selling speed technology into the speed race. So if I'm NASDAQ, though, I have a monopoly over the sale of NASDAQ-specific speed technology. The regulatory incentives for fixing the problem aren't great either, because it's an issue with concentrated benefits, concentrated harm and dispersed benefits. It's a highly technical subject, and any talk of market regulation gets you called communist, which is why Cliff Asness paid me this very nice compliment of saying, actually, you're not a communist. So something I've been thinking about a lot in the last few years is what are you supposed to do as an academic when you have a research idea that addresses a market failure, but where the private incentives to fix the market failure aren't great, and where the government forces that are supposed to fix market failures aren't great either. So what do you do when you have both market failure and government failure? There's an old line of Milton Friedman's, which I love, which he says part of what you're supposed to do as an economist is just keep good ideas active and alive, because it takes a crisis to produce change. And he talked about an enormous inertia in the status quo. And I think part of what I'm trying to do is keep this good idea alive until there's a crisis that calls out for market design reform. But this is just one. I think it's a very good idea. I think it's probably over $100 billion in NPV, and it speaks to the core of what we mean by an efficient capital market. But there are a lot of good ideas from economics that have this structure, maybe the most salient of which is a carbon tax or a congestion tax, where the private forces for implementing the idea are misaligned, and then the government forces for fixing the issue are also misaligned. So it's something that's what keeps me up at night, is what are we supposed to do as academics when we have good ideas that have this structure. Let me wrap now, because I'm out of time, and I'd be glad to take some questions.
Okay, so we're going to try to take 2 short questions, and then we will break. So if I can ask for your patience just for another minute or 2 while we take those questions. If you could raise your hand, we've got 2 people with microphones, one over here. Down here.
Professor, have you studied whether high-frequency trading is more effective in bear markets or bull markets?
So the one most the short answer is high-frequency trading is most profitable in volatile markets. So I don't think of it as bull versus bear per se, but if you think about those slides I showed you towards the beginning, there are a lot of correlated assets. They're bouncing around. If you zoom into high enough frequency, they're not going to bounce around at exactly the same time. They'll be choppy. And the more volatile our markets, the more choppiness there is and the more opportunities there are for sniping. I don't think it's bull versus bear. I think it's volatile versus calm.
So this type of mechanism has been used in many markets to aggregate liquidity at very slow scales, so talking about hours per batch and so on, but you're doing much faster. So I'm wondering, or you're proposing that it be done to be much faster. But so then I'm wondering, how can you actually get rid of the arms race completely? Because there's a question of where information comes. Does your order get into the batch, or does it fall to the next batch? I understand that there might be less incentive to invest in high-speed technology if there's only a question, do you make it into the batch versus not, versus multiple things within the batch. But it seems that it doesn't go away. And the second part is that, did I understand correctly that you're assuming also that information doesn't get disseminated within the batch? And how do you control that?
Yeah, great question. So in a discrete time market, there still would be a benefit to being faster than the competition, but it would be a dramatically reduced benefit. And the way to think about that is that in the continuous market, what matters are relative speed advantages. If I'm a nanosecond faster than you, so remember that slide that suggested that nanoseconds matter in financial markets, billionths of seconds. In a continuous market, if I'm a nanosecond faster than you, then I win the race. Whereas in a batch market, if I'm a nanosecond faster than you and we batch once per millisecond, there's only like a 1 out of a million chance that a 1 nanosecond advantage is economically relevant. So it's still relevant, it's not zero, but it's dramatically reduced. And I think of that as an issue of relative advantages versus absolute. In a continuous market, what matters is just that I'm faster than you. It doesn't matter by how much. And we're now at a scale in the modern speed race where the amounts of time we're competing over are really almost comical.
Okay, so thank you to Eric.